Imagine your favorite clothing brand or tech store suddenly announces a massive 30% off store-wide clearance sale. You don't panic, you grab your wallet, get in your car, and stampede through the front doors to take advantage of the discount. But when the stock market begins dropping by that exact same 30%, human beings often have the opposite reaction. We freeze in terror, hold our heads in our hands, and panic. In the financial world, a 20% or greater drop is called a bear market. But really, all that term means is that the shares of the most successful, profitable corporations in the world have just been temporarily marked down. It is a strange psychological paradox. We intuitively understand that buying a television on sale is a smart financial move. But when we see our investment portfolios flash red, we become terrified of losing what we have and run away from the financial discounts. The wealthy, however, look at the math differently. They do not view market crashes as a crisis. They view a red market as a massive discount on future wealth. Market volatility provides a temporary clearance event that allows you to accelerate your wealth building. To understand why you shouldn't panic, you have to look at the historical data. The stock market is structurally rigged to go up over the long term, driven by inflation and the continuous printing of new money by central banks. This chart shows exactly how that plays out. Historically, a scary bear market where prices fall lasts an average of just 10 months, but the periods of growth that follow, known as bull markets, last a massive 3 to 4 years. The most common error a beginner can make is letting their emotions drive their decisions. They get scared, unbuckle their seatbelt, and sell right at the absolute bottom of the drop. You only permanently lose your capital if you actually sell your shares at a loss. If the price goes down, but you hold on to the investment, you haven't lost a single dollar of your original money. Surviving a downturn requires you to ignore short-term fear and maintain a long-term horizon. You have to ensure you are safely seated in the market when the inevitable recovery begins. Instead of dumping all your money in at once, you can use a strategy called dollar cost averaging. This just means breaking your total investment cash into smaller batches or installments. Let's look at the math. Say you have $1,000 to invest, but the price drops from $20 a share down to $19 and then $18. You deploy the first batch of capital, buying $400 worth of stock at the $20 price point. As the price drops further to $19, you don't panic. You capitalize on the discount by putting in another $300. Finally, the price bottoms out at $18, and you deploy your final $300 of spare cash. By staggering your entries as the market fell, you successfully lowered your overall average cost to roughly $19.06 per share. Because you bought shares at lower prices, you now hold a superior position. The stock barely has to recover, just back to $19.06 for you to become profitable. Dollar cost averaging removes the pressure of trying to time the exact market bottom. It turns price drops into a win-win scenario that accelerates your long-term returns. But what exactly should you be buying when the market is on sale? First, you have to avoid catching a falling knife. That is when you aggressively buy shares of a failing, broken single company just because the price looks cheap. Putting all your money into a single stock exposes you to severe risk. If that specific company goes bankrupt, you face a total loss of your capital. Instead of gambling on just one company, you can choose to buy the whole store by investing in an S&P 500 ETF, essentially a basket that holds the 500 largest companies in the country. Think of these as an upgraded way to invest. One share gives you a tiny piece of those 500 giants simultaneously. A broad market fund is the ultimate set-it-and-forget-it tool. By holding 500 companies at once, you eliminate the risk of any single corporate failure destroying your savings. Before you execute this strategy, there is one absolute requirement. You must maintain an outside liquid cash emergency fund sitting safely in a traditional bank account. You should never invest money you need for rent or groceries. If a life emergency hits in the middle of a market crash, you will be forced to sell your stocks at a severe loss just to pay your bills. Once your cash buffer is in place, you need to protect your emotional health. Your stock brokerage app should be deleted right off your phone's home screen. This prevents the obsessive daily checking that leads to panic. The secret to wealth is to automate your investments, focus on the power of compounding growth over decades, and ignore the media hype. So the next time the news screams that the market is crashing, you won't panic. You will grab your shopping cart because the greatest sale of the decade has just begun.